What happens if one day Interactive Brokers suddenly collapse like Silicon Valley Bank or Credit Suisse? Will your stocks, ETFs, bonds and other investments be safe? And more importantly, can you get back your money in full? Trust me, I had the same worry. I have money in there too. Sure scared one lah, right? So what better way to answer this question than to check their numbers to see if they are in a healthy financial position or, the total opposite. And I will also answer most of the questions that you have on how they would compensate you if anything bad happens to them. But before I dive in, a quick disclaimer: this video is not sponsored by Interactive Brokers and they have no idea that I'm making it. So all my opinions in this video are not influenced by anyone, but I do have an affiliate link down below to receive a tiny commission when you do check it out in the comments down below, and I'll be very thankful for that. Alright, let's jump right in. Let's look at how many new users and trades they have gotten in 2022. From here, you will know if they are still earning good money. Good news is that their customer accounts have increased by 25%, breaking the 2 million mark versus the 1.6 million mark in 2021, thanks to me. This is an important metric because after all, how a broker earns money is through us as investors and traders using their platform. So the more new users, the better. Makes sense, right? And Interactive Brokers, you're very welcome. But it seems like their total trading activity, or what they call the daily active revenue trade, DART or DAT, decreased 17% to 2.1 million compared to the 2.5 million in 2021, mostly because of the decline in the global stock market. No thanks to the sticky inflation, aggressive rate hikes from the Fed, to COVID problems in China, to the Russian-Ukraine invasion, causing traders and investors to be less active. And that's why there were lesser trades, and this decline pattern also happened to one of their direct competitors, Charles Schwab, because I see that their daily average trades also dropped to under 5.3 million for 2022. That's a 13% drop year over year compared to the 6.1 million in 2021. Why is this important? Well, because higher trading activity means more commission, and more commission means higher revenue for the business. It's as simple as that. But the good thing is their commission revenue increased 3% quarter over quarter in Q4 2022 thanks to higher futures contract trading volume and also larger average trade size in options, and not forgetting that their market capitalization increased over 20% year over year to over $30 billion right now. This positive growth tells us that investors' confidence in the company has gone up as well. Which brings me to the next point: Interactive Brokers' annual net revenue for 2022, which is largely made up from commissions and also interest income. That increased over 13% year over year. But what's so special about this? Well, this shows that even with the tough macroeconomic environment, they continue to generate income from their day-to-day operations, while their net interest income is mostly thanks to the large increase in the interest rates by the US Federal Reserve to fight inflation last year, which generated higher interest on its margin loans and also cash portfolio. And meanwhile, their competitor, Charles Schwab's trading revenue has been on a decline for the past 4 quarters. I mean, that just shows who's the boss when it comes to the brokerage business, right? Now, let's take a look at their pre-tax profit margin, which is a metric that measures a company's profitability before paying for taxes. And it is a way for you to tell if they are operating efficiently. In 2022, Interactive Brokers reported a pre-tax profit margin of 71% in Q4, significantly higher than the 62% margin reported in the previous year, despite the bear market, plus there's an increase in employee compensation from $108 million in Q4 2021 to $190 million in Q4 2022. And in their earnings call, interestingly, their management mentioned that this margin is also the highest in the industry. Now, that's something that only an industry leader can achieve, like for example Apple in the gadgets industry, or Coca-Cola in the beverage industry, or Tesla in the EV segment. They all have the pricing power and balance sheet even during a bear market. And speaking about balance sheet, their cash and cash equivalents has increased 43% from $2.3 billion in 2021 to $3.4 billion in 2022, meaning they have over $3 billion of liquid cash on hand. And if you look even closer, and aside from the ginormous amount of customer cash that they have separated out, their securities set aside for regulatory purposes also increased by a whopping 110%, since they did experience a steady increase in customer accounts every quarter in 2022. Why does this matter, you ask? Well, because Interactive Brokers deals with mainly two types of financial products in general: commodities like futures and options on futures, and securities such as stocks, ETFs, bonds, options, and mutual funds. So basically each type is regulated by different agencies and has its own rules for protecting customer assets, and the rules set by the Securities and Exchange Commission, the SEC, and also the Commodities Futures Trading Commission, CTFC, states that customer balances must be kept separated from the firm's assets and cannot be used to finance any business activities or satisfy firm debts. So you can be rest assured that your money is very safe. Now, in terms of liquidity, 99% of its balance sheet is liquid assets such as their cash and short-term investments like treasury bills and also marketable securities, i.e. easily tradable stocks and bonds. And high liquidity means that they can quickly turn those assets into cash in case of any needs. Now let's move into how they are financing their assets. So they reported a debt to equity ratio of 3.14 for 2022, reflecting a huge year-over-year improvement from the 4.91, because a lower DE ratio means the company relies less on debt financing, reducing the risk of a loan default. And this ratio is also considered alright, as even young brokers like Moomoo has a DE ratio of 3.53, plus it's also confirmed by the management in their latest earnings call that they have no long-term debt, or virtually no long-term debt. However, they have a quick ratio of 0.55 as of the end of 2022, and this means that the company has 55 cents in liquid assets for every $1 of short-term liabilities, which is actually a little too low for comfort and raises some concern, as the ideal ratio of liquid assets to short-term liabilities is 1:1, which means they are able to pay off its short-term obligations using its most liquid assets. But actually, I think the quick ratio is not the best metric for this context, because their short-term liabilities are mostly payables. So instead of that, you should look at the short-term borrowings instead, which only stands at $18 million, and that's actually a very negligible amount compared to their current cash position. Okay, you might be wondering why their payables in their current liabilities are so high, and if this is a red flag. Well, it's high because of the fast-paced and high-volume nature of their business, as they handle numerous transactions daily, like buying and selling securities and facilitating margin trading for clients. And not forgetting, they have various ongoing expenses such as commissions, fees, and operating costs. So all of these factors add up can naturally lead to a higher amount of payables in the current liability section of their balance sheet. It's just how their business works. Now, this is the part you won't want to miss, as I'll be sharing how you can get your money back if anything ever happens to Interactive Brokers. First of all, IBKR is a global firm that follows the rules of financial authorities like the SEC and FINRA in the US, the FCA in the UK, and other regulators worldwide. One of the key steps they take is calculating the amount of cash and securities owed to clients on a daily basis, instead of the industry standards weekly or monthly calculations. And what this means is that this provides enhanced protection for clients and ensures faster refunds for you in case of company liquidation or bankruptcy. And of course, as a member of the Securities Investor Protection Corporation (SIPC), Interactive Brokers protects eligible customers up to $500,000 in securities with a $250,000 cash limit for the US. And for the UK, they are covered by the Financial Services Compensation Scheme (FSCS), which safeguards clients up to £85,000 per eligible customer. Basically, that's how much you can get back if anything ever happens, depending if you are using IBKR US or IBKR UK. And worst case scenario, if their SIPC coverage is exhausted, they also extend their SIPC's policy coverage with Lloyd's of London, which basically covers each client up to $30 million with a sub-limit of $900,000 for cash holdings. But the overall payout across all clients add-on together won't exceed $150 million. And just in case you're wondering, no, Interactive Brokers is not insured by the Federal Deposit Insurance Corporation (FDIC), because the FDIC only provides deposit insurance for deposit accounts such as savings account, money market funds, deposit accounts, and certificate of deposit at insured banks. And keep in mind, FDIC insurance does not cover investments in stocks, bonds, mutual funds, or other securities, which are the primary offerings of brokers like Interactive Brokers themselves. So all said and done, I think that Interactive Brokers is in a relatively healthy financial position with continuous growth in customer accounts and a pretty solid balance sheet, even when the economy wasn't and isn't now in the best shape. And there might be a small concern that their quick ratio is a little low, yes, but the good thing is that they don't owe much money in the short term and they have a lot of cash on hand. Almost 99% of liquid cash, and this means that they should be able to pay off anything in the short term without any issues. And remember, they have virtually no long-term debt, so that's additional comfort for you and I. And yes, their latest quarterly results should already be released by the time this video is out, so I will cover that in a separate video. Let me know in the comments down below if you found this kind of analysis helpful. Thank you for watching, and as usual, I will see you in the next one.